I'm John Leske, recently retired personal financial planner and founder of finhealth, a tool to guide you to your financial independence. This is the third of 8 videos that explains finhealth and how it can help you reach your version of financial independence. That is, having sufficient investment wealth to support your lifestyle indefinitely without needing to work. It is recommended that you watch the previous videos if you haven't already done so. In this video and the next 4, we're going to examine the 5 key indicators of financial independence in more detail. These indicators, as you may remember from the previous videos in this series, are 1. Your investment wealth ratio, 2. Your retirement expenditure multiple, 3. Your tax effectiveness ratio, 4. Your growth asset allocation ratio, and 5. Your investment diversification ratio. In today's video, we begin with the investment wealth ratio. But before discussing this ratio, we need to briefly explain its key inputs, net worth and net investment wealth. Net worth is the total of everything you own, that is, house, cars, superannuation, shares, bank accounts, etc., less what you owe, loans, credit card debt, tax outstanding. It is a measure of your total wealth, how much money you would have if you sold everything and repaid all debts. The Barbers, our case study family introduced in previous videos, have a current reported net worth of $3.3 million. As shown on the screen now, this net worth comprises what the Barbers own, their total assets, or TA, less what they owe, their total liabilities, or TL. Assets comprise lifestyle assets of $2.5 million and investment assets of $1 million, for total assets of $3.5 million. Liabilities comprise borrowings of $200,000. Net worth is the difference between total assets of $3.5 million and total liabilities of $0.2 million or $3.3 million. Net investment wealth is your net worth less your lifestyle assets, your home, cars, holiday house. Lifestyle assets don't provide you with any direct income, but hopefully enhance your lifestyle enjoyment. The Barbers' current net worth is $3.3 million and their lifestyle assets are worth $2.5 million. Net investment wealth is the difference between the two, that is, $0.8 million or $800,000. Alternatively, and giving the same result, net investment wealth is your investment assets, that is, your bank account, shares, investment property, superannuation, less what you owe, your total liabilities. The Barbers have investment assets of $1 million and owe $0.2 million for net investment wealth of $0.8 million. Net investment wealth is what is available to live off when you're not working, on the assumption that you never intend to sell lifestyle assets to meet your ongoing lifestyle expenses. Of course, this may be a fallback option, but such an unplanned sale would not be consistent with our view of financial independence. Now, on their own, net worth and net investment wealth don't tell us anything about where the Barbers or anybody else are on the road to their unique version of financial independence. They are absolute measures. If the objective is to simply grow wealth as much as possible, they would be all you needed to focus on. But financial independence is the more enlightened objective of being able to finance the lifestyle you want without needing to work. It requires some relative measures to assess both your current position and changes over time. The investment wealth ratio is the first of such measures that we consider. The investment wealth ratio is calculated as net investment wealth divided by net worth. It measures the percentage of total wealth, or net worth, held as net investment wealth, that is, investment assets less debt. The rest of total wealth is, by definition, held as lifestyle assets, that is, residence, holiday home, cars, furniture, etc. As a rough rule of thumb, but it's not hard and fast, we look for the investment wealth ratio to be above 55% of total wealth to be consistent with financial independence. The 55% is based on Sydney observation. The appropriate benchmark may vary by regions across the country and between countries. However, accepting the Sydney experience, if the ratio is below 55% at retirement, for example, it suggests that the retiree is highly likely at some stage to be forced to sell or borrow against their lifestyle assets to maintain a desired lifestyle. An investment wealth ratio below 55% at retirement is an indication that you're living beyond your means, with too much focus on current lifestyle and not enough on financing future lifestyle. To make this more concrete, consider a Sydney couple just prior to entering retirement at age 65 with a net worth of $6 million. Of this, $4 million is held in lifestyle assets, comprising mainly a nice residence in a desirable affluent area. They therefore have $2 million of net investment wealth to support their desired lifestyle. Their investment wealth ratio is 33% and well below our benchmark of 55%. Again, as a rough indicator, and as discussed more fully in our next video, we suggest that $2 million of net investment wealth could support an $80,000 a year inflation-adjusted 30-year retirement lifestyle. It is not our general experience that Sydney couples with $4 million homes are likely to be content with $80,000 a year retirement lifestyles. $150,000 to $200,000 a year may be closer to the mark, although there will always be exceptions. Maintaining a desired lifestyle commensurate with their lifestyle assets is likely to eventually erode the couple's investment wealth, so that at some time a decision that is inconsistent with the concept of financial independence must be made. Either lifestyle must be reduced and/or lifestyle assets turned into cash, either by trading down the existing home to a less expensive one or borrowing against the current residence. In contrast, consider another Sydney couple about to retire at age 65, who also have a net worth of $6 million. But they hold $2 million of lifestyle assets and $4 million of net investment wealth. An investment wealth ratio of 67%, well above our benchmark of 55%. Again, as a rough guide, $4 million of net investment wealth could support a $160,000 a year retirement lifestyle. Again, based on our experience, this would be considered a very comfortable lifestyle by those who own $2 million of lifestyle assets and don't want to or can't work again. It would be unlikely that they would ever be forced, rather than choose, to curtail their lifestyle and/or sell lifestyle assets. We consider that this indicates sustainable financial independence. Now, looking at our case study couple, the Barbers, their current investment wealth ratio is 24.2%. This is well below the minimum benchmark of 55% that we would regard as consistent with financial independence. Most of their wealth is currently tied up in lifestyle assets. However, they have an anticipated 19 years of expected wealth accumulation ahead of them before retirement. Based on their expectations, their maximum projected investment wealth ratio improves to 48.8%, which is still below the benchmark 55%. Their personal financial dashboard indicates that the investment wealth ratio is projected to decline continuously from peak age 65, as investment wealth is eroded to meet a potentially unsustainable lifestyle. Now, looked at in isolation, the investment wealth ratio suggests some adjustments may need to be made to the Barbers' expectations for them to achieve financial independence. But we need to also look at how they are placed with regard to the other indicators. In the next video, we'll discuss the very important retirement expenditure multiple in more detail. So see you then. And please comment or ask any questions below, and I'll respond to as many as I can. Thanks for watching.